Welcome back to Investing Talk Podcast.
Today we're looking at critical metals.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Yeah, let's do it, because this one is, it's a fascinating and, frankly, a really contradictory case.
It is. It's one of the most, compelling but also confusing pictures we've seen in the materials sector in a while.
Really confusing.
Yeah, mostly because the financial data, it almost seems to point to two completely different companies, depending on how you look at it.
It's like a riddle.
Yeah.
So on one side, you have this, let's call it the processor story.
Right.
And this is looking at their April 2025 data.
Yeah.
And it looks like this incredible growth
The
engine.
numbers are just stunning for this kind of company. I mean, Q1 revenue for 2025 shot up to $26.4 million.
That's a 54% jump year over year.
And it beat the consensus forecast, which was sitting around, what, $22.8 million? So a healthy beat.
Okay, a strong top line is great, but the margin expansion is where the story gets kind of extraordinary.
Oh, absolutely. They reported that gross margin expanded by 12,210 basis points.
And just for everyone listening, can you quickly unpack what that means?
Sure. It's just a 12.1 percentage point increase in their margin, which brought the total gross margin to 44.2%.
And in this sector, a 44% gross margin is...
It's basically unheard of unless you're a massive established player. It tells you their new processing facility is, dramatically cutting their costs.
And here's where it really changes the risk profile for me. The financial health.
The cash.
The cash. That same report showed a net cash position of almost $48 million.
For a smaller company in this space, that's incredibly rare. They usually burn through cash for years.
And they're not just sitting on it, they're growing it. They generated over $16 million in free cash flow in that one quarter.
Which is exactly why management felt so confident. They went and raised their full-year guidance for 2025 all the way up to a range of 115 to 125 million.
So that's story number one. Scaling, profitable, cash-rich. The dream investment, right?
It is.
But then we pull up the second set of reports, the Explorer story, and the picture just completely flips.
It's like looking at a different company. It's bizarre. In this other narrative, the total annual revenue figure was only $560,000.
Wait, 560,000?
1,000. Yes, it was a big increase, 376%, but it's tiny compared to the other numbers.
And instead of generating all that cash...
Net loss, a big one, $51.87 million.
Okay, so this is the contradiction you have to get your head around.
Exactly. And that 51 million loss isn't necessarily a bad thing for an explorer, right? It means they're investing heavily in development. But it does point to some liquidity concerns.
Right. I see the ratios here. The current and quick ratios are super low, like 0.13. What does that signal?
It just means their most immediate assets, like cash, don't come close to covering their immediate bills, which is normal for an explorer. All their money is tied up in, long-term projects.
So how can a company have $47 million in net cash and a 0.13 quick ratio at the same time? It feels like they're two separate companies under one roof.
They almost are. And the market is struggling to figure out which one is the real value driver. The money from the processor is likely funding the growth of the explorer, which is what you'd want to see, but it makes the financials very, very hard to read.
Okay, so we've got a very thesis here. Are you valuing a cash-generating processor or a long-term explorer with a massive asset? Let's dig into the competitive advantages, the moats for both.
Good idea. Let's start with the U.S. processor moat. The advantage here isn't the resource itself. It's about technology and government backing.
Okay, so the material mentions their patented solvent extraction process. Why is that IP so critical?
That's the key to those huge margins we were talking about. The process delivers incredibly high purity, 99.95%, which you absolutely need for military-grade magnet.
And it's cheaper.
Way cheaper. It uses 40% less reagent, so they get that high purity at a much lower cost.
That's a huge barrier to entry.
And then there's the government backing. This is where it gets really interesting. They have exclusive contracts, one with Northrop Grumman for the U.S. Navy.
And they're the only private U.S. company with a contract like that. It's not just revenue, it's strategic positioning. It's a signal.
A huge signal. And that's anchored by the $28 million grant they got from the Department of Energy.
Under the Defense Production Act, the DPA, that's the government basically saying, you are a critical piece of our national security supply chain.
That is a powerful moat. Okay, so that's the processor. Now let's step back and look at the other side. The massive global resource they're sitting on. The explorer's story.
Right. And if you look at it that way, the advantage shifts to sheer scale and quality. They own the Tambreez project in Greenland, which is one of the world's largest known rare earth deposits.
Exactly. And the quality is consistent. High-grade results with total rare earth oxide, or TREO, grading steadily around 0.4%. In the rare earth world, that kind of scale and consistency is exceptional.
But owning a resource is one thing. Building the processing plant is the really expensive, risky part. How are they handling that?
This is the really clever part. They've mitigated that risk through a 50-50 joint venture in Romania.
With Romania's FTCU?
Right? And the structure of the JV gives critical metals what's called a carried interest. It shields them from the massive initial capital spending.
So they get the upside of the processing facility without having to take on all that initial debt and construction risk.
Precisely. It's a brilliant move. And it secures a completely Western-aligned supply chain, from a mine in Greenland to a plant in Europe.
Which is exactly what Western governments are desperate for right now.
And that path is potentially getting a big boost from the U.S. Exim Bank. We're talking about a potential for $120 million in non-dilutive funding.
Wow. Okay, let's shift to the market momentum. Because whichever story you believe, the chart and the institutional money seem to be pointing in one direction.
Yeah, it's a textbook case of positive technicals lining up with a strong news flow.
So on the daily chart, you can clearly see a confirmed cup and handle pattern. For those who aren't familiar, it's a classic bullish pattern that suggests a major breakout is underway.
And when you apply the standard math to it, that pattern points to a price target of around $11.20. So, significant upside from here.
The chart is definitely strong. You had the golden cross confirmed back in March, which is a major long-term buy signal. And the 50-day moving average has been acting as a really solid floor on any pullbacks.
And that technical strength is being backed up by some pretty major fundamental news.
Absolutely. The Department of Defense gave them a critical supply chain certification that makes them eligible for up to $500 million in DoD procurement contracts.
A massive stamp of approval.
Huge. Plus, they announced their first non-defense shipment to a Tier 1 electric vehicle maker. So they're already diversifying away from that defense concentration risk we were worried about.
Now let's talk about who's actually buying this stock during this breakout.
Yeah, the whales. The institutional and insider buying is maybe the most convincing data point here. Institutional ownership is sitting at 86%.
Let that sink in. Nearly 9 out of every 10 shares are locked up by big institutions. That tells you they have serious conviction in the long-term story here.
And they've been adding. Vanguard more than doubled its position in Q1. Fidelity added over 1 million shares.
And the insiders are buying too. The CEO made his largest single purchase since the IPO back in March, and the CFO bought right after him. That's a big vote of confidence from the inside.
Okay, so that brings us to the risks and the road ahead, because it's not a straight lineup. The execution risks here are real, and they stem from those two different business models.
That's right. If we're looking at the processor story, the main risk is revenue concentration. In that amazing Q1 report, 68% of the revenue came from just 3 defense contractors.
That's a lot of eggs in one basket. If one of those contracts gets delayed or changed, it's a big problem.
Exactly. Now, on the Explorer side, the risk is different. It's about potential delays at the Tambreez project. I mean, logistics in Greenland are not easy.
And there's always the external pressure from China, right? If they decide to flood the market with cheap exports, it can crush prices for everyone.
It can. So given those risks, the question is, how do they weather any storms? And the answer is the balance sheet, that net cash position on the processor side, or the potential for non-dilutive funding on the Explorer side.
It gives them a huge buffer. They don't have to sell shares and dilute everyone if they hit a rough patch.
Exactly, and allows them to survive and keep executing.
So what are the key catalysts we should be watching for over the next year or so?
Okay, near term, the upcoming Q2 earnings release is huge. That will tell us if that processor story is continuing to accelerate. Then there's an Investor Day, where we expect to get some real guidance for 2026.
And looking further out for the big Greenland asset.
The key milestone there is the proof of concept pilot plant. That's scheduled for the second quarter of 2026. It will prove they can process the Greenland ore at a commercial scale.
And that's the event that could really transform the valuation of the whole company.
It's the major de-risking event. And all of this is happening with this massive geopolitical tailwind at their back. The need for a secure Western supply chain for these minerals is only getting stronger.
So to synthesize all this, critical metals is a really powerful but also really complicated story.
It is. You have these huge geopolitical tailwinds, but you also have these conflicting signals from the operations.
And the future really hinges on which path they execute on best. Is it the US processor generating cash right now, or the explorer that unlocks this massive Greenland resource?
Both paths could lead to a huge transition for the company. From a sort of speculative idea to a genuine, sovereign supply chain anchor.
It's a bet on execution.
It is. But I'll leave you with this final thought to consider. What does that incredible 86% institutional ownership tell you? It suggests the so-called smart money has a very high conviction that the company will successfully make that transition, despite all the short-term noise and the confusing data.
They're betting that success in one or both of these areas is almost inevitable. A lot to think about there. Make sure you subscribe for our next analysis. Thanks for joining us.